Sole proprietorship versus corporation. Which structure is right for you? Deciding on a business structure is a crucial choice at the initial stage of starting a business. Business structures are broadly divided into sole proprietorships and corporations, and these two forms exhibit clear differences in various aspects. 1. Business entity and scope of liability. The most fundamental difference lies in who the business entity is. Sole proprietorship, the individual themselves is the business entity. All income and debts generated through the business are directly attributed to the individual. If the business faces difficulties and incurs debt, the individual is liable for all debts using not only business assets but also personal assets. This is referred to as unlimited liability. Corporation. A corporation is a separate legal entity that serves as the business entity. The corporation is considered distinct from its representative director. Debts or liabilities incurred during business operations are, in principle, limited to the corporation itself. Shareholders are liable only to the extent of their invested capital, which is a limited liability structure, offering the advantage of protecting personal assets from business risks. 2. Differences in tax burden. Taxation is a very important consideration when choosing a business structure. There are differences in the types of taxes applied and the tax rates. Sole proprietorship income earned from business activities is subject to comprehensive income tax. Comprehensive income tax has a progressive tax rate structure, meaning the tax rate increases with higher income. Depending on the tax base, rates range from 6% to a maximum of 45%, with an additional 10% local income tax, potentially bringing the effective maximum rate up to 49.5%. If income exceeds a certain threshold, which varies by industry, the business may become subject to the sincere reporting confirmation system, making tax management more complex. Corporation income earned by the corporation is subject to corporate tax. Corporate tax rates are generally lower compared to comprehensive income tax rates. However, when the corporation's profits are distributed to the representative or shareholders, they are paid out as salaries or dividends, which are then subject to personal income tax. This is known as double taxation. From a tax rate perspective alone, for a tax base of approximately KRW 21.6 million or less, a sole proprietorship might have a lower tax burden. However, with higher income, a corporation often becomes more advantageous in terms of tax, particularly when net profit exceeds 200 million Korean won. The burden of quasi-taxes, like health insurance premiums, increases significantly for sole proprietors, leading many to convert to a corporation. Sole proprietors cannot recognize their own salary as a business expense, whereas corporations can treat the salary paid to the representative director as a corporate expense, which can help reduce the tax burden. Profits from the disposal of business fixed assets or securities are not taxed for sole proprietors, but they are subject to corporate tax for corporations. Health insurance premiums and national pension contributions for a corporate representative director, classified as an employee, may be lower than for a sole proprietor. However, if there is significant income outside of salary, additional premiums may apply, requiring careful comparison. In terms of value-added tax VAT, the deemed input tax credit rate and deduction limit may be more favorable for sole proprietors, potentially resulting in a higher VAT burden for corporations. 3. Complexity of operation and management. The methods for operating the business and managing accounting and tax also differ. Sole proprietorship for small-scale businesses or certain industries, keeping simple books or even not keeping books at all, may be permitted depending on the revenue size. Tax filing procedures are also relatively simpler compared to corporations. Corporation, regardless of revenue size or industry, corporations are required to maintain double-entry bookkeeping. Accounting procedures are significantly more complex than for sole proprietorships, and tax filing processes are also more stringent. Therefore, it is common to seek assistance from professionals, such as tax accountants or certified public accountants. 4. External credibility and fundraising. There is also a difference in credibility when expanding the business or engaging in external transactions. Sole proprietorship based on the individual's credit, external credibility, may be lower compared to a corporation. It can be relatively difficult to raise funds through bank loans or external investments. Corporation as a corporation is a separate legal entity. It generally has higher external credibility than a sole proprietorship. Corporations are often in a more favorable position for attracting institutional investment or applying for government support programs, and it can be easier to secure the necessary funds for business expansion. 5. Timing for corporate conversion. In many cases, businesses start as sole proprietorships, and consider converting to a corporation as the business grows. The appropriate timing for converting to a corporation is typically considered in the following situations: when the comprehensive income tax burden is expected to exceed the corporate tax burden, when the business's net profit reaches a certain level and the personal income tax burden increases. Converting to a corporation may be advantageous just before becoming subject to the sincere reporting confirmation system as a sole proprietor, since becoming subject to this system increases the complexity of tax filing and management. Converting to a corporation beforehand can be beneficial when external investment is needed or business expansion requires higher external credibility if there are plans to grow the business or attract external funds. Converting to a corporation can be advantageous for enhancing credibility